If you don't know how taxes work here in Canada, you can watch this video because I'm going to tell you everything you need to know right now. For this example, we're going to use Alberta, but the numbers are very similar across Canada. So we have three main types of tax here in Canada. The first one is dividend taxes, the second one is capital gains, and the third one is other income. This includes interest in high interest savings accounts, as well as your salary or your hourly earnings, anything that is not a capital gain, which is making money on an investment, or a dividend, which is receiving money as a payment for holding the share. So for most people, the majority of their income is going to fall into this other income category. Now, when it comes to paying taxes on that income, the first $53,359 of that income is going to be taxed at 25%. Now, the money that is above $53,359 but below $106,717 is going to be taxed at 30.5%. So this means that the more money that you make each year, the higher taxes you are going to pay, but you only have to pay that higher tax bracket on the amount of income that is within that bracket. So now when you figure out what tax bracket your income goes up to, that is going to be your marginal tax rate. And then when you take your total taxes paid divided by your total income, that is going to give you your average tax rate. If you live in Alberta, our tax rates go up to 48% on every dollar you make above $341,502. The system is designed so that if you earn a lower income, you are going to pay a lower percentage in taxes. But if you earn a high income, you are going to pay a higher percentage of that income in taxes. A couple ways that you can pay less taxes are by contributing to your RRSP to reduce your taxable income, investing through your tax-free savings account to reduce your capital gains tax, and by buying your first home using the first home savings account so that you can get both of those benefits. Now, when we start talking about capital gains here, let's put an example to it. So let's say you buy Apple shares at $100 and you sell them at $200, you would now have $100 in capital gains. Those capital gains get added onto your taxable income. So they get added onto your income at the end of the year, but they only get taxed on 50% of the capital gains, which is why you'll notice that these tax brackets right here are always 50% of the other income tax brackets. So let's say that you made a lot of money and you're in the top tax bracket here and you made $100 in capital gains, you would have to give $24 of that back to the government in capital gains tax. Now, the dividends start to get a little bit more complicated because it depends on what country they're coming from, as well as whether or not they're eligible or non-eligible. So if you want to see a full video on that, I'll probably have to do it separately. Leave a comment down below.